and to understand some of the most relevant parts of the financial environment for cannabis brands and to avoid missteps, we went looking for an accountant. And we were lucky to find one in Michael Harlow, who's developed a leadership position in the CohnReznick cannabis practice, dealing with brands that are both international giants and emerging startups. Michael's here to lay out some of the most important areas that can trip up and-coming cannabis brands. So please welcome Michael Harlow.
Thank you so much. So we just finished 2 discussions about brands. I'm guessing most of the people in the room are product focused or creative. And now we're going to take the next half an hour and talk about tax policy and financial and regulatory issues. So, fasten your seatbelts. It's about to get exciting. So I'm a tax partner with CohnReznick. We are the largest national accounting firm currently operating in the space. We are not a cannabis-specific firm. We are a national accounting firm that serves industries across the country. Cannabis just happens to be one of them. And I make that differentiation because we're seeing a professionalization of the cannabis industry as more service providers get in. When we first entered the market about 3 years ago, all of the service providers were small 1 or 2 partner firms, primarily out of Washington State, California, and Colorado. I actually live in Washington, D.C., and run the tax practice for the national cannabis practice. This is my legal disclaimer that our in-house counsel requires us to use whenever I'm talking about cannabis. It just says, don't hold me responsible for anything I'm about to say. All right. So let's back up a little bit and talk about what happened back in December. Because in December we had the passage of the Farm Bill. And there was immediately a lot of misinformation in the market about what exactly the Farm Bill did or didn't do. Pre-Farm Bill, we were working across the country with both THC and CBD-focused brands, manufacturers, cultivators, and retail operations. And we're going to talk a little bit later about the different tax treatment for Schedule I narcotics versus every other business in the country, and why this designation about whether or not CBD is legal or illegal makes a huge difference for financial and tax reporting purposes. But as soon as the Farm Bill passed, every hemp operator and CBD operator that we dealt with called, like the next week, my phone was ringing off the hook, and they were all like, great, we're legal now. Well, not exactly. It's a little more complicated than that. There's cannabis, there's hemp, there's THC, there's CBD, there's CBD derived from cannabis, there's CBD derived from hemp. The question of where you're getting your product and your supply chain management is critical to determining the tax treatment and the legal status of your products. So this is actually directly lifted from well, not lifted because I cited it, but from the Farm Bill, talking about the term hemp as defined, all right? Now, how many people in the room are food and beverage focused brands versus cannabis? So like food and beverage folks? Okay, people with extensive cannabis experience? All right, thank you. I just asked because it kind of changed the direction a little bit of what I'm going to focus on. All right, so there are all these rules in the Farm Bill, but what makes a hemp derivative, okay? It has to be grown in a state under a state program sanctioned under the Farm Bill. It has to test below 0.03% THC per dry weight, and then there's additional testing periods throughout the production life. So what's critical is that this means that legal CBD under the Farm Bill, because the Farm Bill deschedules hemp, not cannabis, but hemp, if it tests under 0.03% under a state program, okay? You can't be manufactured in Europe or China by definition and meet that definition, okay? So I was in a southern state just a couple weeks ago, and I visited a grand opening for a new hemp store. They had infused teas, food products, pre-rolls, everything hemp-based, which they claimed was completely legal. And they also had a lot of their product reps there since it was the opening day. So I was asking them about where their product was sourced from, and almost to a T, they all told me China or Europe. Okay? So think about this. This is a franchise with, I think, 5 or 6 locations throughout the Southeast now, trying to build a brand, trying to grow market share. But when they come to do some kind of roll-up or consolidation, which is what most people in the industry expect to happen over time, any due diligence is going to immediately identify that their product isn't actually qualified under the Farm Bill. All right. Now, I think the industry has gotten a little laissez-faire because we haven't seen the feds take a proactive approach in cracking down on online CBD sales or like this hemp store that's in the southern state. But I don't think we're going to have to wait for the federal government to take action, because I think what you're going to start seeing is that as the people who have spent money to build out hemp facilities in licensed states want to start taking their product to market over the next year, they're going to start pushing the policymakers to crack down on these operators. And we've seen the same thing happen just over the past 2 weeks in California with 2 of the biggest delivery companies in the country who have filed suit against each other over how they're processing credit cards. It wasn't the government that identified the issue and went after them. It was their competition. So think about what that's going to mean for your business valuation if you're not dotting your I's and crossing your T's when it comes to your product sourcing. All right. So for those of you that haven't been to any cannabis events in the past, 280E is always like front and center discussion. So 280E is the section of the Internal Revenue Tax Code that defines taxable nature of illegal businesses, specifically Schedule I narcotics trafficking, okay? If you are trafficking a Schedule I narcotic, you are not allowed under law to deduct anything other than your cost of goods sold. It's your actual product cost. So for a manufacturer, not a huge deal, because 90+% of your product cost is going to be in your manufacturing process. If you're a retailer, that's a very different story. That means that what you're paying your bud tenders, your rent for your retail facility, your insurance, security, all that stuff is non-deductible. The only deduction you're allowed to take is for what you pay for the product. And there's some wiggle room there depending on the state you operate in, because some states allow the retailers to package or modify the product, test it. Others require all the testing, product packaging and everything to be done before it gets to the store. So if you're in one of those states, there's really nothing you can add to that cost of goods sold other than what you actually paid for the product. All right? So all of these are normal expenses that we would see in any other operating business that you cannot deduct in a THC cannabis business. For that matter, you can't deduct it in a CBD business if it's cannabis derived as opposed to hemp derived. So your regular salaries, depreciation on your non-production assets, your rent, your insurance, payroll taxes, your taxes on your license, all non-deductible. So let's walk through a little example of what this means. And this is critical in both understanding how to manage your cash flow and valuation issues for your business. So this is a slide that I normally use when I'm talking about cannabis operators in 280 limited versus like your non-280 limited business. In this case could be a liquor store or 7-Eleven, any other normal retail environment. And then the last column is your illicit market, okay? We could kind of flip this and say that the 280E limited is your cannabis business and the non-280E is your CBD or hemp derivative business, assuming that it qualifies under the Farm Bill, all right? So if we walk through the math, this illustrates how we go from a 21% effective corporate tax rate, which is the new tax rate under the new tax law, to what we normally see in a cannabis retail operation where the effective tax rate approaches 60 to 70%. All right, so it is not unusual for startup cannabis retail businesses to produce operating cash losses, meaning they're taking more money is going out the door than they're making, and still have taxable income. So this creates a fundamental problem in cash flow management. You do not have the money to pay your taxes because you spend it on expenses that you can't deduct. All right? So and this is pretty standard for a small retail establishment. This is like your normal mom and pop. $2 million of sales, $1 million of cost of goods sold, 50% margin is not far off from what we normally see in operations. $700,000 of G&A costs. So your taxable income for your cannabis operator is $1 million. Okay? Your taxable income for your CBD only legal operator, $300,000. Illicit market, $300,000. They're not paying tax anyway. All right? So what this means is the actual federal corporate tax for the cannabis business is $210,000. Actual corporate tax for your CBD business in this case, $63,000. All right? And corporate tax for the illicit market operator is nothing. Okay? So the cannabis business gets to take home $90,000. The CBD business gets to take home $237,000. And the illicit market operator pockets $300,000. And this isn't really accurate because what this doesn't account for is that illicit operator isn't paying payroll taxes, they're not paying insurance on their product, they're probably still using pesticides, they're not paying for testing. So in reality, they're pocketing a heck of a lot more than $300,000. So that's not really the focus of this discussion, but I do think it's interesting to highlight from a policy perspective. If states are trying to move operators from the illicit market to the regulated market, they have to understand the economic incentive. And what happens really quickly here, if this G&A cost goes up just slightly, the licensed cannabis operator is going to take home no money. In fact, they're probably going to come out of pocket to put money back in the company just so they can maintain their license and pay their taxes. Whereas the illicit operator is going to pocket $300,000, $400,000, $500,000. So we need to understand the economics and how this works when we're trying to talk to regulators about, how there's an inherent conflict between what they're saying they're trying to accomplish and what the economics incentive is for the actual operator. Any questions? All right. So, one of the changes that we've seen over the past couple years is that larger operators are getting more and more sophisticated about understanding these things, whereas many of the smaller operators and startup companies are not. And the larger operators are using this to their advantage because we see investors coming to the space, and one of the service lines that has kept us the most busy over the past 9 months has been buy-side due diligence on target acquisitions. So the larger investment group will hire us to come and then look at the sales tax and the income tax filings of the target company, and 50% of the time we can look at that income tax return and immediately tell that they either didn't apply 280E at all or applied it in a very aggressive manner. And as soon as we find that and we give it back to the buyer, they go immediately back to the seller and drive down the price based on that unknown tax liability. So we are seeing unrecorded federal tax liabilities and state sales and excise tax liabilities being used in negotiations to drive down valuations. Now, a year ago, we thought this was going to happen, but we didn't have a lot of evidence to support it. Now we see it come up in every single due diligence project we work on. So there are a lot of operators who have done the analysis that as they're growing the business, they can't afford to pay the tax drag of the 280E tax. So they've either just ignored it or acted like it didn't apply or been very aggressive in their costing. And they might have saved a couple dollars in current tax, but now a year or 2 years later, it's coming back to haunt them when they're trying to sell their business. So we see big valuation issues related to 280E. And even in companies that aren't selling yet, the industry as a whole did not receive much, if any, professional service advice in the accounting finance area until maybe the past 2 or 3 years. So we see more and more operators who just had basic books and records, if that, in the past, moving towards audited financial statements. Well, as a firm, when we do a sign off on an audited financial statement for a cannabis operator, we have to look at their 280E calculations, because that unfunded tax liability could be the largest single liability on their financial statements. So they might not even be ready to sell yet, but they're trying to prepare financial statements in anticipation of something 2 or 3 years down the road. And now we're being forced to tell them that we can't sign off on the financial statements because we know that under IRS audit, they'd get slaughtered. And this has come up time and time and time again. We had an extreme example 2 weeks ago where a California-based licensed company, fully legal, fully compliant, vertically integrated, is now going to go out and raise, $50, $100 million. Everybody in the industry thinks they're going to raise hundreds and hundreds of millions of dollars. But they hadn't filed federal tax returns for the past 10 years. That's kind of hard to get around. So we hadn't had that particular problem yet, and I called the IRS. I was lucky enough to be able to reach out to an IRS agent that was working on an audit on another client that we were doing a due diligence project on. And I got a service manager out of a Pacific Northwest office, and I said, hey, what would you do if we came to you with a client and filed 10 back years of taxes and the client voluntarily paid the back tax? Are you going to slaughter them with penalties and interest, or are you going to work with them if they voluntarily become compliant? And the agent was very sympathetic. I mean, he'd done lots of cannabis audits. He knew exactly what the situation was going to be. He knew that the prior, probably from years like 9 through 1 back, they were going to have no records anyway, so preparing a tax return was going to be kind of a joke. But he was very honest that the IRS does not have a system. There's no national cannabis task force. There's no voluntary disclosure is a general term in the accounting world. It's not unusual for states or federal governments to offer a voluntary disclosure program where if you volunteer to come clean with back taxes, they waive penalties and interest. There's no such thing in the cannabis space. The only advice the manager could offer me was to go ahead and have the client file all 10 years of returns at one time and cross our fingers. That was about it. There was no guidance. They have no process. He said even if you called an agent who works on cannabis accounts and delivered the returns directly to them, because of the staffing shortages in the IRS, all they're going to do is inter-office mail it to the processing center to get the returns processed. So that doesn't even solve any problems. There's a chance that the client would never get audited. They'll just process the 10 returns and move on. But I'm more afraid that we'll file 10 years of returns and the client will then be pulled for audit for all 10 years because there's no statute of limitations because nothing was ever filed. And then if they really wanted to get aggressive, they could start going after all the employees because they're going to ask the client under audit, hey, what's this big expense on your P&L about salaries? And he says, oh, well, that's a salary expense that we paid for all the people in the production facility. Okay, great. Was that reported on a W-2? My guess is not. So the IRS could just keep going and going through the audit chain until they got down to every employee. But now the client has a real fundamental problem. Do I take the gamble, file all these prior year returns, get caught up so that I can go out and raise money, or do I not? And I don't really think they have any good options. If they don't go back and become compliant now, they can't really go out and do a fundraise. They can't ever get financial statements without there being major disclosures all over the financial statements about unfunded tax liability. So their business valuation, even though they are arguably a very popular brand within the market, is going to be shot. So I bring this up because operators are moving so quickly to gain market share and to grow their business and to build some kind of value. If they're not focused on some of these financial accounting details, it's all going to be for naught. So. Okay, another big trend that we've seen, particularly since the rollout of the Farm Bill, is the evolution of national and celebrity brands. And this has changed quickly over the past 6 months. Back in January, we received calls from Canadian operators, celebrity agents. Everybody wanted to go out and buy a hemp farm in Kentucky and launch their own brand. And that sounded great until we started talking about what is actually involved in growing hemp. And it's probably better left to the experts as opposed to the celebrity endorser. So we saw most of those operators abandon those plans almost immediately and move towards launching a royalty or branding agreement type model so that they're not on the hook for the inventory, they're not on the hook for the license, they're not on the hook for any other regulatory or compliance issues, they are just the brand. One of the things that was enabled us to help them change their mind quickly was this 280E exposure. Once we started walking through with them exactly how that worked and what their exposure could be if they didn't really understand their product supply and where their CBD was coming from, and there could be millions of dollars of federal tax due, then most of them immediately said, no, like, we don't want to do that. So, yes, lots of new celebrity and national brands coming out. Most of them are not actually licensed producers. But that gets really complicated in regulated markets too, because depending on how you structure your branding or royalty agreement, if it's tied directly to revenue for the underlying either distribution company or retail company, you could be required to still be listed on the license. So in California, if your revenue is tied directly, dollar for dollar, to revenue for the underlying retail store, you have an economic interest in that license. So you run into all kinds of regulatory issues. Okay, now we'll try to get quickly through banking and finance issues. Folks that have been operating in the cannabis space for a long time are used to these problems. They're used to understanding that they're going to, like the last gentleman just mentioned, you're going to need redundant bank accounts because your bank account could be shut down any minute. You're used to not being able to go out and get a small business loan. You're used to not being able to raise capital in a traditional sense. I'm afraid that a lot of people are moving into the CBD, THC infusion market that are from the food and beverage side, not from the cannabis side, and are overlooking some of these issues. And it happens, I've gotten very used to it, operating in the space over the past 2 years. It's little details that we may not expect in our other industries in which we operate. For example, we just booked a hotel suite in Vegas for a conference later in the year, and I booked the suite personally. I'm a rewards member for the hotel in question. And as soon as I booked the suite, I got a call back from the manager of the property with a 2-page due diligence checklist for the event. Are you going for the cannabis conference? How are you paying for the room? What's the credit card that's going to be paying for the room? Or is there going to be any consumption in the property? We stayed at the same property a year ago and didn't get those questions. So for those of you that are new to the industry, don't be surprised when these little things pop up. All right. So I want to end with this, and then we'll take questions. This is the last, literally the last section of the Farm Bill, okay? And this will blow your mind. Because what this says, if you read it very carefully, is that everything derived from a hemp plant under the Farm Bill is legal, including that minuscule 0.03% THC, okay? So THC, even in very, very small amounts, derived on the Farm Bill, is legal, which means that if you have trace amounts of THC in your products, that is a Farm Bill legal product, it's legal THC. And I think this is fascinating, particularly that it got added as the very last paragraph or section of the Farm Bill. I mean, it's right above the signature lines. So I've had some operators that think this opens up all kinds of opportunities in the future, and I've others that interpret it and think there's no way, because of the limitations on the 0.03% testing at different levels, you can never do anything with it. But you can tie yourself in knots trying to come up with creative ways that that can be applied. And I don't think I've talked to 2 people yet who have the same opinion as to what that means for the industry.
So, thank you. We're going to do questions for about 5-6 minutes now. So if you have them, let's please hold our hands up.
You're going to hold it for me? All right. Thanks. I do have a quick question about the Section 280. If you have a traditional food and beverage company and you operate mostly in that space with all your employees in that space, would you be able to help a client structure so that the majority of their, for example, marketing costs and salary costs were held under their traditional food and beverage company so that just a small amount fell under the THC brand and they reduced their exposure under 280?
Great question. So the cannabis companies have been trying to do this for a long time, arguing that there's different product lines that are subject to 280E and not subject to 280E, that in a traditional retail establishment, 90% of your sales might be cannabis sales and 10% might be paraphernalia and t-shirts and hats. And then they would argue that 10% of your expenses should be carved off and allocated to that. The IRS has taken a very unfavorable view on that, and they've had at least 3 cases in the past year that have attacked that methodology because they've argued that that revenue stream for the ancillary, the paraphernalia, wouldn't exist without the cannabis company. Right. So I think this is a fascinating example. In this case, you have a legitimate revenue stream that's completely unrelated to THC or CBD. So I think you have a very good argument to make. But you may want to take the additional step of segregating not only in a separate business line on your P&L, but a separate legal entity. Because you want to keep all of those expenses as, as separated and as clear cut as you possibly can.
For your cannabis company. So your cannabis company is your manufacturing company, and your non-cannabis company that's a completely separate LLC, completely separate entity, is almost like your celebrity endorser that takes the royalties instead of sales.
Okay, so 2 things. If it's really just a royalty model, if the company's collecting royalty income, never touches the product, never trades in the product, doesn't take ownership to it, we would argue that's not a 280E restricted business to begin with. But I think what you're suggesting is, can I have a management company or my total company that pays all the payroll, which would be a non-cannabis business, fully deductible, and then can I somehow allocate those costs over to the cannabis business? So we've seen this structured using management agreements. It's not at all unusual. It works the same way it would work in a restaurant franchise group where you have a common paymaster who pays all the payroll, and then all the salary costs is allocated out to all the locations. It's our belief that in using a management fee structure, you have to look through to see what the management fee is related to. For example, if you are a license holding entity, like a shell entity, all you do is hold the license and process the product and own the cultivation facility, and you're paying the management company for labor, if the labor the management fee covers is labor related to production, so your trimmers and your people managing the grow facility, deductible. If the labor that you're paying for is related to the bud tenders, even if you're paying it through a management company that's 1 layer removed, it's still non-deductible. You have to look all the way through to see what the underlying expenses are related to. Does that answer? Okay, great.
Excuse me. We have one more question over here.
No.
Yeah, I just had a real top-line question, or a couple, but Is this type of accounting practice and tax code been precedented, and did it evolve into something over the years? And then second of all, is the rationale simply to create a richer tax margin, if you will, for the government? You know, maybe lower tax dollars, but a higher margin?
I don't think so. The 280E dates back to 1982 when there was a case, I believe it was a heroin trafficker, who was convicted in federal court, sentenced to prison, and then they realized that he still benefited from all his theoretical ill-gotten gains. All his money was sitting in his bank account. So Congress didn't think that made sense for the tax code for an illegal drug trafficker to be treated the same way as a regular business. So that was where 280E came from. And the application has been relatively rare up until you saw state-regulated cannabis markets come online. And then the federal government used it aggressively, in my view, not to collect additional tax revenue, but to slow down growth of the industry. I think there's a lot of 280E non-compliance with operators, so I don't think the revenue dollars the federal government is getting is really that significant. I mean, it might be millions and millions of dollars for any one operator, but it's not, in the larger scheme of things for the budget, it's not a big number. I think the number would be much, much greater, actually, if they eliminated 280E or you have the passage of the States Act or something else that descheduled, and then all of a sudden you had everybody actually filing tax returns and reporting all of their income in regulated markets. All right.
Hey, thank you. Michael's going to be here for a while.
Yep, all day.
And, one of the things when you're dealing with specialists, it's great to be able to speak with them offline as well as online. We could do days of accounting. We could do days of legal. What we want to do is create broad strokes so we can know what we want to ask about and what we want to talk about as we go deeper. So thank you for helping us do that,
Thank you
Michael.
very much.